Hello everyone, we're delighted that you're joining us for this webinar on all things agricultural property relief and business property relief. I'm delighted to be joined by Ian and Michaela, who are two of our tax partners as part of Gravita. So we're in great company here to talk about all things APR and BPR. So just to run through a little bit on the agenda and what we will be covering. So on the agenda for this webinar, we'll roughly run for the hour. But yes, we're going to start off with background to changes around BPR and APR, and there have been a lot in this space recently. So we'll go through the timeline of the changes. We'll then talk about what is BPR and a little bit of an overview as to kind of what assets qualify. We'll then be doing an overview the same on agricultural property relief, and then talking a bit about the impact, and we've got an example that we'll be running through as well. The meaty section, and perhaps the most interesting that you all want to hear about, is strategies and what can be done to potentially help inheritance tax problems on these assets. We'll then be talking a little bit about business valuations. Why are they now more important than ever, and how is the business valued? We are running a Q&A at the end, so please feel free to put your questions in the box, and hopefully we'll have lots of time at the end to go through those. And a little bit of housekeeping. So this is being recorded and the slides will be circulated after the webinar. There's also, we've got a great succession hub on our Gravita websites. So we've got that covers all things inheritance tax, and we've got lots of videos. I think you did a great webinar on BPR before Christmas as well, which is on there, where you go into much more depth, specifically on BPR. Well, that doesn't account for the new rules, I don't think.
No. Government changing them.
So to go through the timeline of the changes, so I guess the first bullet points on here should have potentially been that for years and decades, APR and BPR were previously reliefs that were uncapped. So, if your asset qualified for them, there was not a cap, it was unlimited amounts of relief. And then in the autumn 24 budget, we saw a 1 million cap combined on BPR and APR assets for 100% relief brought in. And then the BPR and APR rate was 50% thereafter, so effectively a 20% inheritance tax charge. Then a year later, in the autumn 25 budget, the unused allowance of the £1 million was then said it could be transferred between spouses or civil partners. So when it was initially brought in, it was just per person, and unlike the nil rate ban and resident nil rate ban, it couldn't be transferred. But that changed and it could be transferred. And then on Christmas Eve, I remember it well, the 1 million cap was further amended such that it was extended to 2.5 million. So, now a married couple or a couple in a civil partnership could have 5 million combined. These rules are planning to come in from April 26. And whilst not APR or BPR related, just another point is so pivotal to inheritance tax planning is from April 27, unused pension funds are also going to be subject to inheritance tax. So a whistle-stop timeline of the changes we've seen more recently is quite chaotic, given that we saw absolutely nothing for years and decades, and now we've had big changes all in quick succession.
More importantly, there was no big fanfare when they changed it to 2.5 million.
No, I think it's gone quite quiet, hasn't it,
quiet.
since?
Yeah, I mean, let's be frank. We can probably thank the farmers that are 2.5
absolutely,
million.
absolutely.
And it's gone a bit quiet because most small farmers and businesses probably won't impact as much so at the moment. But we'll get into it in a minute. The key is they will eventually, as with these things move on over time.
So over to Michaela, who's just going to run us through kind of what is business property relief and the current rules and what qualifies.
Okay, thank you, Kelly. Okay, so business property relief is familiar to a lot of people. It's 100% relief when it applies to particular assets. When I say 100% relief, rather than paying 40% IHT, you get it at 0%, or at least currently you do. Now, it's available on broadly, as it says in the title, business property. And by business property, we mean shares in trading companies usually. You can actually get it unlisted companies. So unlisted, as long as you own 50%?
Control.
50, yes. You've got to control the company. So we don't have very many clients that control listed companies, but if you do, then 100% relief could do on that. Whereas it's unlisted, you don't have to have a minimum. It's also on assets that are used in a business. So it would be, again, if you control the business and you have assets held outside of the business, you can get 50% business property relief on those assets. Also, if it's used in a partnership and you're a partner, that works as well. And for sole traders. So it is trading profits. Now, not everything qualifies as a trading asset. So there are two tests to look at. Firstly, as to whether or not the asset itself qualifies. And then if it does qualify, does all of it qualify? So we start with looking at, does the business qualify? And there's broadly a 50% test. And there are a bunch of tests that you have to look at that include looking at where the turnover is coming from, where are the assets based, or what are the assets for? And what are the resources being used? So what are staff doing in the business? How long is it taking you to generate income or generate trading income? So what we look at is and then we look at it in the round. Does it smell like a business? Does it look like a business? Does it look like a trade? Would a normal person on the back of an omnibus think that this is a trading business and not something else? Now, if you can kind of meet those tests and you're happy with your 50% test, then you will probably get BPR, subject to HMRC conversations, of course,
Right.
on the assets. We then have to drill down a little bit to see what the business actually owns, because particular assets may be excluded from having business property relief on them.
Yeah.
So you would have to adjust the price of the shares. Now, you've got some good examples of these, of accepted assets, but I guess the big one's cash, which catches people out.
Cash that's not required for the business, effectively. We'll come on to this with valuations, but having detailed working capital calculations on what you do and don't require for the business
Really
has
important.
never been more important.
Really important.
Effectively. Businesses do well.
Yeah,
People
you
hoard
accumulate
cash.
cash.
They may not distribute it, they may not keep it for other
Yeah.
purposes. So watching that excess cash is incredibly important. Board minutes and other things,
Yeah.
what you're going to do with it.
You need to be very specific that the business needs that cash, and it will either be for working capital, because we know how much a business needs working capital, or very specific plans that you have. So for an investment, so for example, you know you're going to buy new premises and you're hoarding cash, accumulating funds in order to buy said premises, then making sure you have got a really good note on that. You've got board minutes to say that's what you're going to do, what's it going to cost, what are you going to buy. That's really, really helpful, because if the money is just seen as a rainy day fund, and we've spoken to council about this recently, if it's just called a rainy day fund or you don't have a specific reason for having it, then that's very likely to be treated as an accepted asset by HMRC, and that will reduce the amount of value that you can attribute to a business property relief related item.
Very fair. If you have accepted cash, the answer is probably do something with it.
Absolutely, invest it.
Invest it
in something
in the
for
trade,
the trade.
or maybe not for the
Not
trade.
for trade, true.
Maybe it could be for a business or a property rental income, which might still mean the business qualifies because of this 50% rule.
So we have some interesting cases where the difference between what an accepted asset is and whether a business is trading or not are slightly different, because you don't necessarily, for the asset to be used by the business, it doesn't necessarily have to be for a trading asset, does it?
No, it has to be for a business asset.
Business
What's a
asset.
business?
What's
What's
a
a trade?
And it turns out that rental properties can be business, although not a trade. So just need to be a little bit careful about that, because specifically property businesses are excluded from qualifying for business property relief. But you may have a property business within a trade or within a trading company, and sometimes we have seen those be allowed for BPR relief.
The other accepted assets, I suppose, is assets used for personal use.
Absolutely. So if you've got a holiday home in there, even if it is undoubtedly a trading company or a holiday yacht, or however it's appealing,
Helicopter.
helicopter,
What's your
all
choice?
these nice things for personal use, you are not going to get relief for those. They will be accepted assets when you're calculating the value of the shares that will qualify for that relief.
Yeah.
Interestingly.
Perfect. And Ian, did you want to talk a little bit about agricultural property relief?
Yes, it would be remiss of me not to, considering the comment I
title.
just said about farmers and how they've done a wonderful job in changing this. Look, let's be frank, the £1 million cap that was there before was really, really going to impact farmers.
Really,
We have a lot of farmers, and the farmers I act for, and I hope some of them won't be remiss of me saying this, you probably need 150, 200, 250 acres of land just to break even and make a profit.
And I think we said before as well, what's that, £10,000 an acre value, you're already at the 2 million.
Absolutely, and
mark,
that's at the bare minimum.
Without machinery and...
Tractors are expensive, I understand. I mean, I'm
Very
sounding, I don't know. I'm told tractors are expensive.
Six figures. And then if you get into buying combine, you probably wouldn't buy a combine for that smaller piece of land. You probably rent it as a community asset. But yeah, you're talking about hundreds and hundreds of thousands of pounds worth of assets in relation to that. So this is really important. The 2.5 million cap being increased is going to be immensely important for a lot of farmers, because effectively it's 5 million if you're a husband and wife, but also £650,000 if you've got your nil rate bands
Of course.
on top of that, if you don't have any other assets. So I think it's safe to say now the vast majority of farmers will be not impacted.
Less impacted.
However, we were talking earlier that these £2.5 million caps are not increasing until 2031. And fiscal drag has been a factor in inheritance tax for a long time.
Yeah, I mean, it's not changed for 16 years. The 325 grand has not changed. And we've been promised that there will be changes to that. It's never happened. So 2031 turns up. Do we think it's going to happen?
Yeah, I'd put money on it. Still not. I mean, they've announced that it could rise.
It's a nice round number, isn't it?
Yeah.
So,
yeah.
Let's wait and see. So
I'm being cynical. Sorry.
I mean, the key to this, and I suppose it's a crunch point for this sort of webinar, even if you think you're not affected by the 2.5 million now, because you have that, in 10 years' time, you may be affected by it. So early planning is quite important. So you can sort out your affairs now, ready for in the future, because hopefully your business, farm is going to grow, become more valuable over time.
Point in having it.
That's the point in having it. So anyway, agricultural property relief. So effectively, it is what it says on the tin. You get agricultural property relief on farming assets or farming assets that are used for agricultural purposes. And that is the very key point. So what are we talking about? We're talking about land, agricultural land. We're talking about barns that are in use for agricultural purposes. We're talking about farmhouses as well. In certain aspects, there is a very important point in relation to the character of the assets. So take your farmhouse. I give this example all the time. It's a terrible example, but I will find one at some point. If you have Blenheim Palace with 100 acres, that's not going to qualify for agricultural property relief, because the character of Blenheim Palace would have to support the whole of Oxfordshire being a farm to
I think in case law they do call it the elephant test, don't they? Like, does it look and smell like a farmhouse? Is like actually in case law.
Quite right. But even if it's not all qualifying for agricultural property relief, some of it may be. So there's usually a percentage basis. I think our rough estimates are usually 70 to 80%, but that might be some of the type of the clients we have, because we have some quite big landed estates clients that go through this as well. But the important thing about this is, if you farm on your farming land and it's a farming activity for agricultural purposes, as long as you do it for 2 years, similar to the BPR, it should qualify for agricultural property. There is also a rule for farming business tenancies, which is FBT, which is where effectively you allow someone else to farm the land for you and they rent it, they pay rent to you. And as long as you do that for 7 years during ownership, you're okay. You're going to qualify for agricultural property relief. Slight snag on that, providing the person that's renting it actually farms it. Because you can fall over on that. I know you may have an FBT in place, a tenancy in place. They generally have to farm it to.
Do you think, I'm going to, slightly controversial question I'm going to throw out here, but do you think that may be one of the reasons why some of these rules are changing, to stop people from investing and letting it out? And for 7 years, they've suddenly got this APRable asset, historically.
I won't say some of the big names of people
I wasn't
business
going to suggest one either,
that have bought up vast amounts of land in this country, but you all know who they are.
Yes.
Ultimately, it was a very good inheritance tax tool, and it probably didn't do well for farming as a whole. Yes, they are probably doing that in part for this, but if they really cared about that, they would change the rules on the 7 year and not cap the whole lot for the actual genuine farmers. I think that's what I probably would do. Couple other things on APR, because I know this is not all about farmers. If your tenancy was before 1995, you're only going to get 50% relief. So have a look at your tenancy.
It just takes a renewal to literally 50 to 100%.
Didn't know that.
The fair point to make is farming is tough. If anyone's a farmer and you try and make money out of being a farmer, it is tough. So with the grants reducing the subsidies, you're seeing a lot of diversification in farming
Yeah.
activity at the moment, but that leads to inheritance tax and APR issues potentially. 'Cause it depends what the diversification activity you're going to go into.
Yeah.
To give you some examples that are not going to qualify, solar panels, wind farms, that sort of thing.
Sure. Fine. No, okay.
That
Well,
sort
that
of
wouldn't qualify.
no, solar panels, this is an investment activity
Wow.
in itself. I mean, the way you structure this and the way we've done it for a lot of clients, imagine you have a client with 1,000 acres and they put 200 acres of solar panels on. If you have it within a partnership itself, you may be able to get the activity of 50%
Interesting. Okay, yeah.
to qualify for BPR on that
Yeah.
instead of APR.
Yeah.
The only other point is, and I know it's happening a lot in this country, is planning rules are changing for houses and residents. A lot of people are selling up land for residential developments and commercial,
Which certainly won't qualify.
which certainly won't qualify. But if your land is on the edge of a town, it's not just going to have agricultural value of £10,000 an acre. It will have development value. Not a
very much a
problem, because you can still get BPR on it if
Yeah.
you structure it in the right way.
Yeah,
It's
absolutely.
something to think
Yeah.
about.
Yeah.
Absolutely. And valuations we'll come on to later anyway. But I think
Very important.
it's interesting what you're saying about not making money as a farmer. Do you think that will have an impact on the valuation? I know we'll come to that anyway, but I think that's an interesting point as to what the value actually is.
We could talk about the valuations now. So
Sorry.
some people have told me, or some people have been trying to make the argument to me, well, surely we should value farmers on earnings, profit, and that sort of thing. In which case, you go up and down the country, and farms would be not worth,
It'll be so far.
not worth a lot of money. I think the reality of that is that'll be very difficult. And I don't think HMRC will go
Yeah.
along that line. But it's a fair point. If someone wants to make the argument, we're happy to put input in,
Absolutely.
and we'll go that way. But the
Yeah.
land value will be so high, I doubt that will
Yeah,
fly.
yeah. So as Ian said, as one of the keys here is that farmers qualify for agricultural property relief up to the agricultural value, and then they're relying on business property relief thereafter to take us to market value, which is a bit of an important distinction. So just to summarise exactly what we've discussed, so the new rules from April 26, APR and BPR combined will only relate to the first 2.5 million. It is transferable to the surviving spouse. So even if the spouse has already died, they would be deemed to have not used any of their 2.5 million. So it's 100% still available. So then in this instance, the surviving spouse beyond April 26 would still get 5 million combined. Then it's a 50% rate thereafter, so 20%. And you can, if your assets qualify for APR and BPR, and there is tax to pay, you can qualify for payment by instalments over 10 years, which is interest-free as well.
It is on this, and usually if you're paying by instalment to HMRC, it's not interest-free, but they have made a specific exception to
Yeah.
this. So that's a good thing, I guess.
I think that's a very good thing.
Yeah.
Have you ever tried selling a business or farmland or anything like that? It does not happen within 6
No.
months of death.
Absolutely
So
not. God, no.
And the interest rate applied is quite beefy as well, isn't it? It's,
The interest rate is well over 7% at the moment. So it's very high. It's very high.
Yeah. Or ordinarily it would be due kind of 6 months after the chargeable events. So they have relaxed it as well for the payments due. So Michaela, to run us through the example
Yeah,
for this
absolutely. And
business.
this is an example. You sat through my earlier BPR presentation last year when we had different rules. We use a similar example. But at the moment, if you've got somebody in shares with a trading company that's worth 10 million, owned by a husband and a wife, then you want to pass that on to your kids. There is no IHT to pay on that because of BPR. In 3 months' time, that suddenly becomes £1 million tax bill overall over time, because you're going to get only get £5 million relief. The other 5 million will be taxed at 20%. And so we got the problem then of, can we afford to pay it? So there is a massive impact. How is it going to be paid? We've already talked about the paying over 10 years, but you've still got to get the money out of the business somehow. And we will come on and chat about that in a moment. Because there's a level of double taxation, isn't there? Let's
talk about it now. It's no problem. So your example, what was the value?
We've got to pay £1 million because they've got a £10 million.
Okay, so
set of
find £1
shares.
million worth of tax. Or,
Yeah.
Perfect. So all the money's in the company. The company might not even have the money. We'll talk about the valuations, why that's the
where are they
case
going to
in
get
a
cash
moment.
from?
Where they're going to get cash. Equally, the executors have got to get the cash out of the company to pay it. Usually when you declare a dividend,
You've got to pay some more tax.
you've got to pay some more tax, which is ridiculous. Now, I'm right in saying here that the executors, if you're an executor of an estate, you pay the lower rate of dividend tax, don't
You'll
you?
pay the lower rate on it, but of course, if it's then deemed to belong to the person who you
Indeed.
they will then pay a higher rate. But I mean, if you're using it to pay the IHT, you don't necessarily have that problem.
But it depends on the will, I guess.
It depends on the will. It depends on the will, but you have got a tax bill, an income tax bill.
But the way to avoid that dividend tax charge is probably to do a share buyback.
Yeah.
And the way that these sort of things works is that, I don't know, if you have 100 shares and you've got £1 million worth of IHT to pay, the company effectively buys back the shares and distributes that cash to the executors. Why is that different to dividends? Well, under the law at the moment, you can get capital gains tax treatment on it, which would be a bit cheaper. Equally, because of so the shares are now worth, for base cost purposes for CGT, whatever the value was at death. So in effect, you can get it out tax-free.
I would hope minimal CGT.
Minimal, because you don't know much time it takes
absolutely.
and that sort of
But
thing.
there's a lot of conditions you've got to meet in order to get that treatment, presumably still.
Usually, yes. There's
less on death, I guess,
less on death, but you still need stuff like HMRC clearance and bits and pieces like that.
It's not quick.
But it's not quick, and if you want to pay the IHT within 6 months, I know you've got the 10 years, but if you got the cash and want to, you want to get going with these sort of things.
The company needs cash as well for that route as well, which
Quite right.
Yeah.
And then what about though if the executives would have preferred to have kept those shares? I mean, that's also unhelpful.
Yes, I mean, if I gave you the very simplest example of someone owned a business and
If it was
died,
100%, I guess it's
100%, and they still end up owning 100%. But you're quite right. What if
there are other shareholders? Because you are diluting the holding at that point for the person who is having to sell their shares.
And I suppose that's a decision that executors make in case with all assets. Do you want to keep the house or sell the house?
Yeah,
Inheritance tax has to be paid. It's going to be difficult.
That's hard.
Yes.
Certainly, we don't want to liquidate the company because that's a big risk. If you liquidate the company, it's gone forever, and that doesn't just impact family. That impacts, if this is a local business that people are running, you are going to have an impact more generally on the local economy, and that's a really sad thing to see happen, I think.
Every business person I speak to cares about their employees profusely, and a lot of these businesses are their baby, and quite rightly so. If realistically, because of these new rules, if you don't want there to be an issue, and it sounds horrible to say, but it's true, but if you don't want there to be an issue and there to be an impact, planning early is key. Just having conversations about and figuring out what to do and how it impacts you. Because I'd hate to come across in 5-10 years' time a business that had to go under because of an inheritance tax bill. It'd be horrific.
And these are kind of small private companies, and the other solution is you would just sell the company, but there's rarely a market. There's not like a ready market available to sell the business, is there? And
if you ever bought and sold companies before, you're not going to get the right price
if
it's a for sale. It's just not going to happen.
No,
it's not good news for.
But hopefully, with the effectively £5 million threshold, it does give a lot of protection for the smallest businesses. And hopefully a little bit of relief.
Yeah.
We'll come on to the valuation point when Kelly
talks
about that. You are absolutely right, those smallest businesses.
Yes. So just to go through some kind of strategies and planning that can be done, if I just maybe pick off one of the easier and the most obvious one, essentially, give this away now. So everyone knows that if you give a gift and then you survive for 7 years, it will fall outside of your estate for inheritance tax purposes, known as a kind of lifetime giving. If you survive the gift by 3 years as well, you benefit from a reduced inheritance tax rate, so 40%. That's kind of on a tapering down scale from 40 for between 3 and 7 years. This can cause big problems though, because lifetime giving as well, we have to think about capital gains tax. So when you give away an asset, you're deemed to have disposed of it at market value. So, I give shares to my adult son. Yes, potentially helpful from an inheritance tax point of view, but there could be a capital gains tax charge. With regards to the assets that we're talking about, those that qualify for business property relief and agricultural property relief, these are usually trading assets. So, there might be scope to be able to hold over the capital gains tax. So it may not be a problem, but particularly a problem with, these non-trading assets, the CGT charge in lifetime. Can you also afford to give up the asset?
Yeah, it's the income.
Yeah, so if you're mum and you're relying, on the dividends from your shares or the income from your properties, what are you going to live on if you give it away for IHT planning? And another big killer as well is if you're giving an outright gift, you're losing complete control over that asset. do we trust our children or
You're asking me?
or
Why
I
I
don't
don't
think
have
you
them.
trust children.
I trust my 12-year-old, yes.
Oh, well done.
What about who they may marry in the future?
I haven't met them yet.
Exactly, and
So
they're in a trouble.
that is a problem with lifetime giving, and that's potentially where other solutions like trust or family investment company may be better. And Michaela,
Yeah, so trust, I'm a big fan of trusts. If you've sat through presentations with me before, you'll know that I think they get a bad rap. They're not a solution to this particular problem, but they are a tool that can be used to help alleviate it slightly. So if you do have value that is going to go well above the 2.5 million or the 5 million combined, popping it into a trust now, so before April 2026, well, this year now, isn't it? Before April, if you pop it into trust now, you can potentially lock in that BPR because we still have 100% BPR relief. So when you're setting up trust, there is usually an immediate charge for inheritance tax, at a lower rate than there is on normal tax, on normal inheritance tax, but there is an immediate charge. If you've got a BPR qualifying asset, there is no charge for that. In addition, you can hold over the capital gain. So like with lifetime giving, there is the ability to hold over, although that needs to be done with caution, because if you are holding over an asset, you are losing the potential to the right to the uplift on CGT on death at a later date. It's a way up between is CGT in future going to be less than the IHT in future? So usually, I don't know, it's a conversation for a different day. But either way, when you've got a trust, you can pop your assets in before April. If they qualify for BPR, there's not going to be that immediate charge. If something happens to you within 7 years of setting the trust up, though, those will come back into charge, and it will be the rules at the time of your death that are considered. So if you're dying after April 2026, hopefully, you've then got to recalculate everything, and there potentially could be a charge for inheritance tax at that point. It may be possible to insure that, and we are working with various people who are providing those sort of insurance products. We don't do that in house, so.
Just on the insurance, sorry to interrupt you.
No, not at all.
It's not that bad.
No.
Insurance is it's inexpensive at the moment.
If you're under, I think I've seen it under 75, for example. I had someone I spoke to the other day had about a couple of £1 million, and they were paying less than £1,000 a month.
Yeah, I've seen some very good deals on this, and you say under 75, it's not too bad. Under 65, it's actually even cheaper.
Yes.
So it's certainly worth looking at taking those sort of steps now to protect for 7 years, and you're only going to pay it for 7 years if you can do that kind of insurance. But once it's in the trust, you do still need to have a think about inheritance tax, because yes, after 7 years, it falls outside of the estate of the settlor, or the person who put the money in, and it's also outside of the estate of any of the beneficiaries, which is great. So no more 40% charges, at least for 125 years, if you leave it in the trust, which is great. But the trust itself will, of course, pay a charge to inheritance tax. If the asset continues to qualify for business property relief, there will continue to be a £2.5 million or 5 million combined relief within the trust, and then the excess is chargeable to inheritance tax at a rate of 3% every 10 years. So 3% versus 20%, and you've created the extra band as well. So you've the extra 325,000 tax free. So there are still reasons for doing this, although setting up a trust is not necessarily the cheapest thing in the world to do, and it does take a little bit of time. So if you haven't started thinking about it, definitely something to talk about now. And the rules aren't complicated. Calculating what the reliefs are going to be every 10 years is not straightforward. Calculating exit charges, if you want things out of that trust, not straightforward. And the big one, of course, is if you pop it into a trust now, you can't use it again. It's going to belong to the beneficiaries going forward. So your spouse can't use it. For income tax purposes, there's a problem if you've got minor children of your own, not grandchildren, that's fine, who are beneficiaries. But it's not something to be entered into lightly, but it can help to lock in that BPR 100% charge now.
The way I see it working, or I've seen it working very well. So we've got the 5 million, let's say for an example, on APR, BPR and bits above that. What you are moving to, because it's only 20% inheritance tax above the APR, BPR, and it's not 40%. If it's only 3% every 10 years, that's between 60 and 70. I wasn't going to do the math quite exactly. 66 years if you take it on average. And then you never have to, never have to worry about people's death for tax purposes. You never have to worry about people's death.
But you could skip potentially 3 generations in that time,
and it can be,
over the 125 years. Money.
And the trust can be set up to say specifically, this is for generations
Absolutely.
to come. You don't have to specifically say.
Yes, you can
a
have
single
unborn
person.
beneficiaries. So it can be for the benefit of, I don't know, my adult children and any generations beyond them. And then you can add other people in as well. So there's lots of flexibility at who can benefit from these.
How does the £2.5 million work then? So if I had, I'll give you a terrible example. If you don't like,
me.
if you had 4 grandparents and they each settled a trust each with a part of an asset, would they each get 2.5
Because it's
million?
per settlor.
Yeah.
It's per settlor. And I think it refreshes in the same way as the 70s. I think it does.
Yeah, I thought it refreshed.
Yeah, I think it refreshes in the same way as a normal 325 does every 7 years.
So the
That's
key
one
then is to have lots of grandparents and
Who
people
are
in the family are going
absolutely,
to
absolutely,
do
and to
this.
continue to kind of settle those trusts. It is slightly more complicated than that, and the way that whether a trust will get it, because there are rules as well, transitional rules between those trusts that were settled before
30th of
30th of October 2024, and now. So there are slightly different rules. So for older trusts, the rules will be slightly different. For newer trusts, they've got these transitional reliefs. So again, needs to be quite mindful about when the trust is settled. It's not quite as good as it would have been if you'd settled it before, but unfortunately.
I quite like trust because there are tax benefits to it, as we said, spreading it over a long period of time, and knowing when the inheritance tax is going to come in is really important.
You can plan.
But equally, I mean, I don't know if anyone on this webinar has any black sheep in their family. I hope not.
I am the
But you are the black sheep. I would not agree with that. You know, it protects from life events, bankruptcy,
of course. Yeah.
addiction,
Divorce.
Yeah.
That's
you
the big
know,
one.
it
That's the big
keeps assets within
Yeah.
the family, and that's
Absolutely.
incredibly important.
And you can specifically you can specifically exclude spouses from a trust, as I found out recently. You can definitely exclude spouses from a trust.
Yeah.
So you keep it within the bloodline, not just the family.
Yeah.
Great.
Yeah.
Sorry.
Ian, do you want to talk about the perhaps trendy new equivalent of a trust that everyone's probably heard a lot about in a family investment company?
Sure. I'll just say one thing before I go on to that, and I've been talking to this about this with my clients a lot. When you've got businesses or farms or anything that qualifies for APR or BPR, please have conversations with the next generation about what they're going to do with it.
Are they going to keep it?
Because if you're talking about the wonderful gifting that Kelly mentioned, that's fine, but then you don't get the uplift on death. And the capital gains tax is 24%, which is above 20% inheritance tax.
Actually achieve nothing at that point.
You've worsened your situation, if anything. So it's very much worth having a conversation.
Definitely.
Family investment companies.
Yes.
Very trendy. We actually have a video on YouTube if anyone wants to go and watch it. It's very good. It's been done by our colleague Tom Alcott. Now, it sounds fancy, but in short, it is a company. So if you've been involved in companies before, you'll know how they work. And the way it tends to work is we tend to have family shareholders as shareholders of the company having different interests in the company. So to give you the prime example of one I set up last month, 2 parents set up this company. They either put cash in it to invest, property to invest, might already be a business that they're going to sell, or might just be a business they're going to keep. They have voting shares, maybe some income shares, and the children have capital shares and maybe some income shares. And what that does is it enables capital to grow towards the children and maybe even grandchildren, as opposed to the parents and grandparents.
This is where a trust comes in, because you can actually have the shares held by your trust. So I do it as a double layer thing.
And I agree with you, because the one we set up ended up with a trust being owned by it, because then it gives ultimate control at the top of everyone.
And trusts still have a place.
But effectively, it still becomes a family investment company. And if you have, say you've sold your business or you've sold a property and you've got a lot of cash, having a family investment company just to put the money in as a loan, let it grow, get income from it, take the loan out tax-free, but all the growth goes to your children via the trust or their shareholding. The tax savings are great. And what I've also seen, having done this for a while now, I've been doing this for about 10 years or so, they're not new on the block, is that you start getting children in conversations about investments, because this is an investment vehicle for the family. It's not a vehicle just for individuals, and maybe it might even keep families together a little bit more.
Or create more arguments.
Or create more arguments. Let's not go into that.
Sorry.
Yeah, great. So yeah, trusts and family investment companies, both great solutions, and even a hybrid of, potentially a trust overlaid with a family investment company as well. I think we talked about lifetime giving, insurance. Anyone want to add anything on insurance apart from that it's a really good product that people should look into
Absolutely.
with our financial advisor friends?
Yep, definitely. And there are plenty of people out there offering these either for more general paying inheritance tax or for these 7-year periods.
And you can write it into trust, can't you?
You can indeed.
So
Yes.
effectively, it doesn't add to your inheritance tax.
Exactly. So
Yes.
again, lots of smart things our financial planning friends can do with those.
Yeah, okay, great. So business valuations, I guess these haven't really been overly important, especially where APR and BPR have been uncapped, because the importance is being making sure your business or your farm, whatever it is, actually qualifies for the relief. But now we have got a cap and there might be some IHT exposure. Business valuations have never been more important, would you say?
Correct.
They've never been more important. I always thought they were important anyway because they gave you a base cost for which you were going to
of
sell the
course, yeah.
business or the farm in the future. But everyone used to estimate it and just put an estimated figure on the IHC 400 form, and then we'd always have to go back 20 years ago and try and figure it out. But because everyone got inheritance tax relief, no one really cared, and it was all good.
Yeah.
Nowadays, it is incredibly important, and the best way I can explain it to you is probably with an example. Imagine if you have a business that does £10 million turnover and £1 to £2 million profit. Sounds pretty good, right?
Yep.
That's fine. Probably doesn't have a lot of cash in truth, because it's continually reinvesting and growing. The way a business is usually valued, there's a few valuations, but the main way is a multiple of profits. And that's profit before tax, interest, depreciation, amortization, all the good things we learn about when we do our accountancy course in the early days. Michaela's grimacing because
Long time ago.
Okay, but the point is, the way the valuation usually works is you do a multiple of that. So the multiple, the UK 200 group is a group of accountants and other organisations that produce a lovely report every year of what multiples are in each industry. And the average for the SME, just as a broad spectrum, was 5.4 last year.
Okay.
But that can wild vary with industry. So if you're a software company or even the insurance sector or anything like that, you can see, I've sold companies that have been 15 to 30 times multiple of EBITDA. So if you've got a £1 to £2 million EBITDA business,
It soon multiplies up.
it soon multiplies up absolutely exponentially. You might have a property in it and everything else. And then it comes onto the position of where you're going to get the cash to do that, because the business has to keep going. You can value a business in another way. And this is where experts come in, like myself. This is not too big-headed for me to say, or some of the other people we have in Gravita, where we look at it overall and try and come up with really good arguments to give a very fair valuation. I use the word fair because I can't use the word low or in anything, because we would never do that. It's fair valuation, but you can use methods such as discounted cash flow, which is effectively looking at what you think the future cash flows are going to be for the business and discounting it for inflation backwards, or looking at just an asset valuation on the business, depending on what that is.
Discounting in general, presumably, for minority holders.
That is a very good point. And it sort of links to the point where I said, if you've got 4 trusts sewn in a business, you discount it.
Because you would for a home, a property that's owned by more than one person, you discount that for IHT purposes.
So the purpose of the discounting for minorities is, if you have 10% of a business, it's not worth 10% of a business, because no one will probably want to buy 10% of a business for a couple of reasons. They don't have control. They don't have control when dividends are declared. They probably don't even have control over when it can be sold. They just have an interest. Now, the usual discounts for minorities can vary quite a lot, but you can get maybe 40 to 70% off the actual linear value of a business.
And that's a lot when you talk about times that by 40% or 20% in this particular case.
It's a huge lot, which is probably why it's so important to have 4 trusts and 1 trust in this case. Or even in the scenario where, say you have a business that you're thinking about passing it into a generation, but you're not too sure, give your children, start it off by giving them a little bit. And then a little bit more, and then you can see how with reducing the value, and then the discounts come in. It can vastly reduce your inheritance tax estate.
So we do business valuations in house, like Ian said. So if clients want their business valued, then that's definitely something that we can look at, and helps to address the inheritance tax exposure at the start before going into possible strategies and help as well. I think we're going on to the Q&A now, unless either of you want to add anything else.
A couple of points. I've got a
Okay.
couple written down. Directors' loan accounts.
Yeah.
If you have a company and you've lent money to the company, which many do to start it up or whatever it is, your director's loan accounts does not qualify for BPR.
No, so it will
It just
reduce the
doesn't.
value of the shares, but it's a separate asset in your hands for IHT purposes.
Correct.
It will not qualify for BPR.
And it could be quite substantial.
Oh, it could be,
these
absolutely, yes,
sort of things.
definitely.
And that will have a 40% inheritance tax
Indeed.
because it won't qualify for
Will not
BPR
qualify.
at all. There is a solution, which is we issue shares, but they're redeemable shares, redeemable preference shares,
Okay.
which act like a loan, but enable you to withdraw it at any time, to have an interest dividend, however you want to do it. But importantly, it's not a loan, it's shares. I know that sounds very convoluted,
No.
but for tax
It's a
purposes, it's
different
shares,
distinction,
but
yeah.
it acts like a loan. That would be really important for a couple of people on this webinar. One final point that I think is very important is groups. We
Yeah.
have a lot of businesses that we act for, and there'll be a lot on this call that have companies all over the place in the group. Maybe they have a holding company with a property in it, or maybe they have IP in another company, and all these sort of weird, wonderful things. The way HMRC look at groups for BPR is they look at it as a whole,
Yeah.
see whether it qualifies for the 50%,
Absolutely.
and then they'll drill down to individual companies on the accepted asset regime. So, for example, the best example I'll give you, if you have a property in a holding company away from the trading company, if it's used by the trading company for the
All
trade, you're all good.
Yep.
If it's rented to someone else,
Problematic.
you're going to be problematic and you're going to have inheritance tax due. The solution, move that property into
Yeah.
the trading
Yeah.
company, and hopefully it's still 50%.
Yeah. So
Yeah.
definitely tidying up your group structures for planning purposes
No,
is
no one
very
thinks,
sensible.
no one
No.
thinks about
It's
it
very
as
sensible to do
inheritance.
with that.
Very
Very
sensible.
And
Absolutely.
again, what about intercompany loans? Because I know that can cause a problem when there are loans from a trading business to a non-trading business within a group. Those sort of things also need looking at. And I know there are a few solutions kicking around that can deal with those at the moment as well.
There are issues all over the place with that documentation. There's never any documentation
No.
on intercompany loans. It's so annoying. But you can do stuff like capitalise the loan
Absolutely.
into the holding company.
Write
You
them
may
off.
be able to write
Write
off
them
the
off.
loan, write off the loan, subject to detailed advice, of
Absolutely,
course, because
yes.
it can be a bit complicated in legal advice. But all these sort of little intricacies when you've got these things are so important. So if you are thinking about inheritance tax in your business and care about it, and want your employees to go on for the future and future and future, get someone to have a look at it.
Yeah.
And it's never too early to get a BPR review done. That sort of
No,
thing.
that's
You and I
true.
do a lot of is reviewing these so people understand before they do any planning what their options are and to plan for the future as well.
Yeah.
Excellent.
Perfect. So looking at the Q&A, the first question, where does one draw the line between BPR and APR where agricultural activities are undertaken in a corporate company can both be claimed?
So, in short, bit of a niche one.
Yeah.
Is that you don't
Yeah.
have many farms that are owned by companies. But
So
we-
farms are so loss-making usually because of investment into plants, machinery, etc., that we
Yes.
would never ordinarily advise that they're in a limited company structure because then their losses become, it's hard to use their losses. And
Yes, and individuals get loss relief,
exactly,
which is
much more
capped at
beneficial.
50 grand, and they have this
Yeah.
weird rule on farmers where it's only 5 years because they thought people were
Averaging
just
rules.
hobby and farming
Yeah.
for years and years a day. Maybe when MP started farming back in the 60s and
Yeah.
70s, they avoided that. But in short, so company shares can qualify for APR. The nuances between APR and BPR are quite challenging because you have to look at the underlying assets of the company, see what's for agricultural purposes. Because I don't know if this company has, for example, a farm and a load of rental properties in it, or something else in it. But the way the BPR and APR rules work is they're counterintuitive. So APR will come first, and if it doesn't qualify, then BPR will come next up to the 2.5 or 5 million that you have for individuals. So it shouldn't usually make too much of a difference because you're looking at it as one.
Yeah.
Does that make sense?
Good. Yeah, fine. Okay, and sorry, one for Ian as well. Please reconfirm the 200 accountants group that share business value multiples.
Can we share a link afterwards?
Yeah.
It's called the UK 200 group. If you Google UK 200 group, 2025 EBITDA, they have a whole report on it, and we'll share it afterwards with people so they can have a look.
Perfect. Maybe one for you, Michaela. Are there additional BPR IHT risk around large excess cash balances on the balance sheet?
There is indeed. We talked about this a little bit earlier. It's about making sure you've clearly documented why that cash is there and what it's going to be for. So to reiterate, board minutes, clear plans. It's not just because you might need it. It's got to be a clear plan as to why you want that cash there, because otherwise that is a problem, and it could be an accepted asset, reducing the level of BPR that you would get on an otherwise fully qualifying asset.
I've seen people fall down where they say to the revenue, "Oh, we were holding the cash because we might buy something."
Can't be might. We
Can't
are
be might.
planning.
Definitive.
And there's also, I was reading a piece of advice from council yesterday actually, and they were saying that if you were looking to spend that money between 2 to 3 years, and you had a plan on that would be likely to qualify. If you were looking between 5 and 7 years, that wouldn't. And there is a timing on it as well. So if you have immediate plans to use that money, you're going to get it. But if the plans are too far down the road,
I had a really good
was risky.
argument with HMRC about accepted cash, where I argued that because of the industry they're in, they might have litigation in the future.
Interesting.
And other
Successful.
companies in the industry have had litigation, and we got about 80% of the cash
Impressive.
off. So little nuances like that we've got a lot of experience
Yeah.
of can really help you.
Yeah, absolutely, absolutely. And it is that percentage. You say you might not get all of it, but if you can get more of it than HMRC wants you to get,
Yeah.
you still quit in.
And document before, so
Document
then you've got
before.
the papers to give afterwards
I
as
mean,
well.
going back to that point, the one thing we didn't say is if you do have accepted assets when settling a trust, and this applies now, even before April, if you have got accepted assets in a company and you're about to settle into trust, the 100% BPR will trigger a charge, or you won't get it in full, that will trigger a charge going into your trust. So you do need to be careful with that. So getting those BPR reviews done early to include accepted assets, doing that before you try and settle into a trust is absolutely key, because otherwise you could end up with a tax liability payable within 6 months of settlement that you really weren't expecting.
Good advice.
Yep. Yeah, great. Can you transfer shares in a trading company into a FIC without a CGT charge?
Yeah, that's
The answer is usually no, because a company cannot claim
Holding, yeah.
What you would usually do is you could do a share for share. So a share for share is effectively you transfer a company to another company, and instead of having cash or just gifting it, you issue shares on top of it.
Yeah.
To do that, that
doesn't achieve anything from a FIC point of view, or IHT planning really.
So it doesn't achieve anything because you could just make the trading company a FIC itself. So you could adjust the shareholdings on top of that. What it does achieve, and it's a really good point. I love it when people put points in me that I can just give some guidance. Is having a holding company is very important for a lot of things. So the example of can you transfer a trading company to a FIC or a holding company could be really powerful, because having a holding company enables you to potentially sell your trading company tax-free in the future.
Yes, correct.
By a substantial shareholders exemption.
Really
so if you're thinking of doing a FIC and you still think you may sell in the future, what the listener's example is, it could be really good, because you could end up with a holding company that's a FIC and a trading company that you sell tax-free.
Yeah.
Gets reinvested for the family. What a wonderful thing to do for your children and grandchildren.
Yeah, perfect. I think there's no more questions, that unless anyone's going to pipe up very quickly with something, I think that's it.
But do get in contact if there are any more questions. We are happy to help. So again, we'll be sharing the slides later, and get in contact at that point.
Yeah, so thank you so much everyone for attending. As I said, we have this great Succession Hub on our website with lots of other videos, webinars, explanations as to family investment companies and all sorts. So please do have a look there. And thank you so much for joining. Thank you.
Thank you very much.
Bye.